Hello everyone. Welcome to EduTap and welcome to today's session. So the Monetary Policy Committee meeting concluded yesterday and the change in the base years have been confirmed. So for the real GDP, for the CPI inflation, there is the change in the base years that have been confirmed that we are going to discuss, and we will discuss that what is this Monetary Policy Committee as well as what are the major decisions that have been taken by the Monetary Policy Committee meeting, as well as we will discuss about the growth and inflation outlook and what is the macroeconomic situation right now. All of this we are going to discuss in today's session. So this session is going to be very important for you because the change in the base years is something that has been discussed for so much of the time, but right now it has been confirmed, and the Monetary Policy Committee has discussed about it and has confirmed that yes, the Monetary Policy Committee has also is also going to bring the data on the basis of the new updated base year. Okay, so this is the idea. Today we are going to discuss about the highlights of the Monetary Policy Committee meeting that has concluded very recently only, that is yesterday only, and we will discuss about the major ideas, the major concepts in today's session. So let's have the clarity. As you know that the Monetary Policy Committee, this is very important, as well as the decisions that have been taken by the Monetary Policy Committee, that also we are going to discuss. So good morning everyone, welcome to the session, and I hope everything is good, everything is fine, and I hope I'm clearly audible and the screen is visible. So give me a thumbs up and let's move forward. Let's continue with today's session. Okay, so give me a thumbs up if everything is fine. And before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel in which you will get the PDF of the session. And the link for the Telegram channel is provided in the description box below. Okay, so the Monetary Policy Statement 2025-26, this has been released. Channel of EduTap, so that okay. So the Monetary Policy Committee held its 59th meeting from February 4th to 6th, 2026. That means the Monetary Policy Committee meeting concluded yesterday only, and this Monetary Policy Committee meeting was held under the chairmanship of Shri Sanjay Manotra, the Governor of the Reserve Bank of India, and the other members were also present in this meeting. So see, this Monetary Policy Committee, this is a committee of the Reserve Bank of India. Now the RBI has the primary objective of the monetary policy. The primary objective is to maintain the price stability. Maintain the price stability while keeping in mind the objective of growth. Okay, so basically the Reserve Bank of India has the responsibility to conduct the monetary policy, and the main objective or the primary objective of monetary policy is to maintain the price stability while keeping in mind the objective of growth. So the Monetary Policy Committee of the Reserve Bank of India conducts the monetary policy. So it is the Monetary Policy Committee of the Reserve Bank of India that conducts the monetary policy. Okay, and the monetary policy is conducted with the primary objective to maintain the price stability while keeping in mind the objective of growth. So this is the idea. So Monetary Policy Committee is a very important committee of the Reserve Bank of India that conducts the monetary policy. Now in the Monetary Policy Committee there are 6 members. 3 members are from the Reserve Bank of India, while the other 3 members are nominated by the Government of India. Okay, so Monetary Policy Committee has in total 6 members, 3 members from RBI and 3 members nominated by the Government of India. Now the 3 members from RBI, one is the Governor of the Reserve Bank of India, Governor of the Reserve Bank of India, another one is the Deputy Governor, and another one is the member that is appointed by or nominated by the Central Board of the Reserve Bank of India. Okay, so these are the 3 members from the RBI, and the Governor of the RBI is also the chairperson of the Monetary Policy Committee. The 3 other members are nominated by the Government of India, and these members have the tenure of 4 years and they are ineligible for reappointment. That means they cannot be reappointed. They have a tenure of 4 years. So this is the idea about the Monetary Policy Committee that consists of the 6 members, 3 members from RBI and 3 members from the 3 members nominated by the Government of India for a tenure of 4 years. And the chairperson of Monetary Policy Committee is the Governor of the RBI. Let's say that there is equality of votes and 3 people are saying yes to a decision, 3 people are saying no to a decision. In the case of equality of vote, the Governor of the RBI, that is the chairperson of the Monetary Policy Committee, has the casting vote, that is has a second vote. Okay, so let's say the Governor of the RBI is saying yes to the decision, so that decision will be taken. So this is the idea about the Monetary Policy Committee. Now, let's continue with the idea about the monetary policy statement that has been recently released. So, this monetary policy committee meeting concluded, and in the meeting, as per the detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate under the LAF unchanged. So, first of all, see, in the monetary policy, the key rate, the most important rate is repo rate. Okay, so in the monetary policy, the very important rate is repo rate. Why the repo rate is such an important rate? Because the repo rate is the rate at which the RBI lends the money to the banks. Okay, or the banks are able to borrow money from the RBI under the repo rate, and the banks have to provide a collateral to the RBI. This is the idea. Now, the repo rate is the rate at which the banks take the money from the RBI, or the RBI lends to the banks. So, repo rate is the rate, is the lending rate at which the RBI lends to the banks. Now, if the repo rate is increasing, the interest rate will increase in the economy. If the interest rate is increasing, so at the higher interest rate, less loans will be taken. If you are taking less loans, that means your demand is decreasing. That means the prices will be controlled and inflation will get controlled in the economy. So the repo rate is increased to control the inflation in the economy, because with the increase in repo rate, the interest rate is also increasing. Now, if the repo rate is decreasing, the interest rate for various loans will also decrease in the economy. So if the repo rate is decreasing, interest rate will decrease. At the lower interest rate, people will take more loans. So with higher loans, with more money in the hands of the people will demand more, and with more demand, there will be more production, there will be more growth in the economy. This is the idea. So repo rate is the rate at which RBI lends to the banks. Okay. Then there is another important rate, that is the SDF rate. This is the deposit rate of the RBI at which RBI takes the deposit from the banks. Okay, remember that the repo rate, that is the lending rate of the RBI, it is always higher than the SDF rate, that is the deposit rate of the RBI. By how much? So repo rate is always higher than the SDF by 0.25%. So the lending rate of the RBI is always higher than the deposit rate of the RBI by 0.25%, because no bank will give you the deposit rate higher than the lending rate. That will never happen, right? So the lending rate is usually higher than the deposit rate. Okay. Now there is also another rate, that is MSF rate. So under the repo rate, the banks cannot take unlimited money or unlimited borrowings. So repo rate has certain limits, or under the repo rate, the borrowing by the banks have certain limits. Banks can borrow till a limit only. But what if the bank is in the liquidity crunch and the bank requires more money? So the higher amounts can be borrowed by a bank under the marginal standing facility rate. But if the bank is borrowing more, the bank also has to pay more rate. The more interest rate the bank has to pay. So the MSF rate is higher than the repo rate by 0.25%. So under the repo rate, there is the limit that how much borrowing a bank can take from the RBI, how much money a bank can take from the RBI. If the bank wants to have more money, if the bank needs more money because the bank has liquidity crunch or the bank is under the problematic situation, so the bank requires more money, the bank can take more money, but under the MSF rate that is higher than the repo rate by 0.25%. So it has been decided, as per the Monetary Policy Committee meeting, as per the recent meeting, it has been decided that the repo rate will be kept at 5.25%. Now the SDF rate, the deposit rate, is less than the repo rate by 0.25%. So how much will be the SDF rate? If the repo rate is 5.25%, SDF rate is 5%. Okay, MSF rate is higher than the repo rate by 0.25%. So MSF rate is now 5.5%, and bank rate is always equal to MSF rate. The bank rate is always equal to MSF rate. So if MSF rate is 5.5%, the bank rate is also 5.5%. So after a detailed assessment of the evolving, of the changing macroeconomic developments or the conditions, macroeconomic means that the whole of the economy, when we are studying about the whole of the economy. So a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC has voted unanimously to keep the repo rate at 5.25%, and with that the SDF rate is 5% and MSF and bank rate are 5.5%. Now this is known as the LAF corridor. The floor, that is the bottom, is the SDF rate. At the middle there is the repo rate, and at the top there is the MSF rate. Okay, so this is the LAF corridor. This is the liquidity adjustment facility corridor. Through the repo rate, RBI provides the loans, RBI provide the money to the banks. So through this rate, the RBI injects the money. Through the lending rate, through the lending, the RBI injects the money. Through the SDF, through the deposits, the RBI absorbs the money. Okay, so this is the liquidity adjustment facility. Chalo. Now moving forward, the MPC also decided to continue with the neutral stance. Now what is the meaning of neutral stance? Neutral stance means that the RBI in the future can increase the repo rate or can also decrease the repo rate. If there is more inflation, if there is higher inflation and the inflation is becoming a problem, the inflation is increasing very rapidly, the RBI can increase the repo rate so that the interest rate can increase, and at higher interest rate there will be less loans, less demand, and inflation will be controlled. But if the RBI wants to boost the growth, if inflation is not a problem and RBI wants to boost the growth, RBI can decrease the repo rate. Decreasing the repo rate, the interest rate will decrease. At the lower interest rate, more loans will be taken, more demand, more growth in the country. Okay, so neutral stance basically means that right now the RBI is neutral on the basis of the evolving situation, on the basis of the future situation. The RBI can increase the repo rate in the coming meeting, or RBI can decrease the repo rate in the coming meeting. This is the idea. Okay, so this is the basic decisions that have been taken by the RBI and by the RBI Monetary Policy Committee. Okay, any confusion till now? Now coming to the next one, that as per the first advance estimates, so as per the first advance estimates, the real GDP is projected to grow by 7.4% in 2025-26. So RBI in its RBI Monetary Policy Committee in its previous meeting projected that the real GDP growth, for 2025-26 will be 7.3%. So in the previous Monetary Policy Committee meeting, the projection was given that the real GDP will grow in 2025-26 at the rate of 7.3%. But the first advance estimates of the real GDP, they are projected to grow by 7.4%. That means there is further higher real GDP growth that is projected for 2025-26. This is due to the strong private consumption and fixed investment that is happening in our country. The external demand is still dragging, still low because of the imports. They are exceeded by the exports. The imports, they are exceeding the exports. We are importing more than what we are exporting. Okay, and the external demand is still low for the exported goods. On the supply side, the real GVA, that is gross value addition, the total value addition that has happened in our country, that has increased by 7.3%. Okay, so the real GDP is projected to grow by 7.4% for 2025-26 because of the private consumption, because of the fixed investment, though the external demand is not very good, and that's why the imports are exceeding the exports. On the supply side, the real GVA, the gross value addition growth of 7.3% is projected for 2025-26. So gross value addition growth, the real gross value addition growth is projected at 7.3%. This is supported by the strong service sector performance, resilient agriculture, and a revival in manufacturing. As well as consumption outlook. So if this is about 2025-26. Now, if we talk about the outlook that is for the future, the consumption outlook is that the consumption is going to remain good and the consumption is going to increase. The demand is going to increase in our country because of the private consumption that is expected to be supported by the strong performance of the service sector. With the strong service sector, there is stable income that the people are expecting to get. So the consumption outlook is positive. GST rationalization has happened. The GST rates have been rationalized. Now, most of the commodities have the GST rate of 5 and 18% rather than multiple rates. Okay, healthy Rabi crops. So the good Rabi harvest can lead to higher income for the rural areas, for the agriculture for the farmers, so the farm incomes are expected to increase. With the good Rabi harvest, the farm incomes are expected to increase. With that, the rural income will increase and the rural consumption will increase. Monetary easing. So what has happened? Try to understand that since February 2025 till December 2025, there was the decrease in the repo rate from 6.5% to 5.25%. Okay, so in February 2025, the repo rate was first decreased from 6.5% to 6.25%, and since then there is the decrease in the repo rate till 5.25%. So from February 2025 till December, from February 2025 till December 2025, there is the decrease in repo rate from 6.5% to 5.25%. Okay, so here you can understand that the repo rate has been decreased by 1.25%. With the decrease in repo rate, by 1.25%, the interest rate is also slowly decreasing in our country. With the decrease in interest rate, at the lower interest rate, more loans will be taken. More loans means more demand. More demand means more growth, more production in the country. Okay, so this decreased interest rate. Now, when the repo rate decreases, there is the monetary policy transmission that happens. Monetary policy transmission, it takes time, because with the decrease in repo rate, with RBI decreasing or Monetary Policy Committee decreasing the repo rate, the interest rate takes time to decrease. The banks take time to decrease the interest rate. So monetary easing, that is the repo rate has been decreased from February 2025 till December 2025. The repo rate has been decreased by 1.25%. So the interest rate is also slowly decreasing in the country. That will boost the demand in the country. Okay, benign inflation, the inflation is also at lower level. Investment outlook is also very positive. The investment activity is likely to maintain momentum because of the high capacity utilization. The machines are being used in the factories to their optimum capacity, and to increase the production, more investment will be required. Conducive financial conditions are there, strong balance sheet are there, and robust credit growth is happening. Government's continued capital expenditure push. So government is also giving the push to the capital expenditure to the investment. Okay, so this is the idea. Now the service export are expected to remain strong because of the strong service sector performance. Merchandise, that is the goods exports, will get a boost from the prospective trade deal with the US. Okay, as well as if we see the external sector, the trade pact with the European Union, coupled with, so there was a comprehensive trade pact that we have recently signed with the European Union, coupled with the trade deals with the New Zealand and Oman, expected to diversify the exports and strengthen the external sector. So the comprehensive trade pact with the European Union, coupled with the trade deals with the New Zealand and Oman, is expected to diversify the exports and such. Risks are still persistent. Geopolitical tensions, global trade uncertainty, volatility in the financial market, international commodity prices are also very volatile. So they are posing the downside risk. So the growth outlook, that is the real GDP growth for 2026-27, is revised up to 6.9% in quarter 1 and 7% in quarter 2 of the 2026-27. Now, why the growth outlook is not given for the whole year of the 2026-27, why the real GDP growth forecast is not given for the whole of the 2026-27, why only for quarter 1 and quarter 2 only? So basically, the Monetary Policy Committee has said that the projections for full year, that is for the 2026-27, the real GDP projections will be provided in the next monetary policy resolution to be announced in April 2026. So the next Monetary Policy Committee meeting will happen in April 2026, in which the real GDP projections will be given for the whole 2026-27 for the whole financial year. Now, why in the next meeting? Why not right now? Because the MPC has stated that we will be incorporating the new GDP and CPI series. So actually, for the real GDP, for the national accounts, for the real GDP, for the real GVA and such, it has been said that the financial year 2011-2012, the financial year 2011-2012, they were taken as the base year. For the real GDP, the financial year 2011-2012 were taken as the base year. Now, for the real GDP, the new base year will be the financial year 2022-23. So there were a lot of discussions that were going on that we have to change the base year for the real GDP, and now finally it has been decided. So the second advanced estimate of the GDP for the financial year 2025-26 along with the past 3 financial year GDP estimates as well as quarterly GDP estimates as per the new base year will be released in February 2026. So you can understand the basic idea here is that the new base year is going to be adopted, and it has been adopted, and soon the data will be released. So for the real GDP, the base year is changing from 2011-2012 to the 2022-23. Okay. So real GDP, I hope you know that the real GDP is calculated by taking the current production multiplied by the base year prices. So before, the base year prices were the prices of the financial year 2011-2012. Now the financial year 2022-23, it will be taken as the base year, okay, for the real GDP calculation. So I hope this is very much clear. The MOSPI, that is the Ministry of Statistics and Program Implementation, is currently in the process of revising the base year of the national accounts from financial year 2011-2012 to financial year 2022-23. Soon the data will be released in February 2026. So the RBI has also said that, or the Monetary Policy Committee has also said that we will also, from the next meeting onwards, we will also take into account the new GDP series with the new base year as well as the CPI. The CPI inflation, that is the inflation, the consumer price index inflation, the inflation that affects the consumers, that affects the prices affecting the consumers. Okay, so inflation that is affecting the consumers. For the CPI inflation, before the base year was 2012. Now it has been said that the base year for the CPI series will also be updated to 2024. So base year for the CPI series, the base year for CPI was 2012, which is now being changed to 2024. And from the next Monetary Policy Committee meeting that will happen in April, from the next meeting, the new base years will be taken into account, okay, for the real GDP and for the CPI. I hope this is very much clear. And this is very, very important. The MOSPI has given the green light for the change in the base year as well as for CPI series also. The base year is changing from 2012 to 2024. This has also been notified by the Monetary Policy Committee that from the next meeting, the new series will be adopted with the new base years. That is the idea. Chalo. Now, headline CPI inflation remained. We have discussed about the growth outlook, and we have discussed that the real GDP growth forecast for 2026-27 are only given for quarter 1 and quarter 2. The yearly, that is for the whole of the year, the growth forecast will be released in the next meeting, okay, because of the change in the base years. Now coming to the inflation outlook. See, the inflation, the CPI inflation, that is the inflation that is affecting the consumers. For that, there is a target. So the Monetary Policy Committee must maintain the price stability, and the inflation should be within the range of, or the inflation should be around 4%. This is the inflation target, within the range of plus minus 2%. That means inflation should not go below 2% and inflation should not go above 6%. So this is the inflation target, that the CPI inflation should be around 4% within the range of 2% and 6%. 2% is the lower tolerance level. The inflation should not go below 2%, and the 6% is the upper tolerance level. The inflation should not go above 6%. Okay. So these are the, this is the tolerance band. Okay. So this is the tolerance band. The inflation should not go below 2%, should not go above 6%. Now what has happened, that the headline CPI inflation, the CPI inflation, the consumer price index inflation, or the inflation that affects the consumers, for which the target is set, that is the 4%. The CPI inflation should be around 4%, should not go below 2%. Okay. Now it has remained low at 0.7% in November and 1.3% in December. That means the headline CPI inflation is below the tolerance band. The CPI inflation is below the tolerance band. Inflation should not go below 2% because the prices, if the prices are slightly increasing by 2%, let's say, so with the slight increase in prices, the profits are increasing for the producers. Even small increase in profits makes the producers happy, we can say, or with the small increase in profits, there is the incentive to the producers to produce more. So the prices should continue to rise at least by 2%, okay, and the lower tolerance level is 2%. Now headline CPI inflation has remained below the tolerance level, below the lower tolerance level. So should RBI be punished? Actually, the central government has notified that what will be considered the failure in the maintenance of inflation target. So RBI has to maintain the inflation target at 4% within the range of 2% to 6%. Now central government has said that it will be considered a failure to maintain the inflation target. It will be considered a failure to maintain the inflation target within the tolerance band if the average inflation is more than the upper tolerance level for the 3 consecutive quarters, that is for 9 consecutive months, and if the average inflation is below the lower tolerance level for the 3 consecutive quarters, that means 9 consecutive months. So remember that yes, the headline CPI inflation is below the lower tolerance level, but right now the RBI, the MPC will not be answerable, because the failure of maintaining the inflation target is when the average inflation is less than the lower tolerance level for 9 consecutive months. Okay, so right now it is only 2 months, so it is fine. Now, while food group continue to be in deflation, that means the food prices are decreasing. The inflation is present in the fuel group, but it is moderate in November and December. The core inflation, that is the CPI inflation, excluding the food and fuel prices, that is excluding the volatile prices, is known as the core inflation. So core inflation is CPI inflation that is affecting the consumers, excluding the volatile prices, excluding the food and fuel prices. So core inflation is the CPI inflation excluding the food and fuel prices. It remained benign, it remained moderate despite the pick up in the prices of precious metals. So excluding gold, the core inflation remained stable at 2.6% in December. Now near-term outlook, that is for the future, the food inflation is likely to remain benign only due to healthy kharif production, adequate food grain buffers and favorable rabi sowing. Upside risk to inflation, yes, there is some problems that can come from the external factors. So geopolitical uncertainty is present, coupled with volatility in energy prices, possible volatility from the precious metals that we can see. The gold prices are rising, they are rapidly increasing and such. So volatility in energy prices and volatility from precious metals prices and adverse weather events, these can lead to risk in inflation. But the projection for CPI inflation for 2025-26 is 2.1%. Now for 2026-27, why the projection has not been given right now? Because the base year is changing and the MPC has stated that in the next meeting the projections will be given. Okay, so this is the idea. Overall assessment is that the inflation pressures are muted, inflation pressures are easily handleable, but excluding the precious metals. That is the idea. Now, rationale for monetary policy decisions. So economic activity remains resilient because of the domestic factors. The economic activity, the economic conditions are resilient because of the domestic factors, but we are facing challenging external environment. Okay, so now seeing all the conditions, the growth is happening in a good manner. The growth forecast has been increased from 7.3% to 7.4% for the 2025-26. So the growth is happening in our country and the inflation is also controlled. So right now the MPC is of the view that the current policy rate, that is 5.25% of the repo rate, is appropriate, as well as in December the central bank has cut the repo rate by 25 basis point, that is by 0.25%. So from February last year, that is from February 2025, the RBI started to decrease the repo rate, so that the interest rate can decrease in the country. With lower interest rate, more loans can be taken. With more loans, there will be more demand. With more demand, there will be more production, there will be more growth in the country. Because the inflation is under control, so right now RBI is focusing on growth in the country. So in February 2025, the repo rate was decreased from 6.50% to 6.25%. Okay. So since February 2025 till December 2025, as I have told you, that there was the decrease in the repo rate by 1.25% in total. From February 2025 till December 2025, there was the decrease in repo rate by 1.25%. That is by 125 basis points. That is 1.25%. So since February last year, there is the decrease. Since February last year, there is the decrease in the repo rate by 1.25%. So with the decrease in repo rate, still the interest rate is being decreased by the banks, and the monetary policy transmission takes time. So interest rate is decreasing, and right now we are looking after the conditions. So if in future it is required, we have taken the neutral stance. So in future we can decrease the repo rate, or if required, we can also increase the repo rate. So this is the idea. So this is it for today. I hope you enjoyed the session. I hope you understood that the base years have been changed, and this was a decision that was discussed for a long time, and many of the students were asking that since when are we going to follow the new base years. So now is the time that the new base years are being followed, and the new base year for the CPI will be 2024. So the base year was previously 2012, which has been changed to 2024 for CPI combined inflation. Okay, and for the real GDP, the base year is changing from 2011, 2012 to 2023, 2022, 23. Okay, so this is a big announcement that you have to keep in mind. The new base years you have to keep in mind, very important from the phase 1 perspective. Now this is the first question. I hope you will be easily able to answer this question, and this is the second question. Okay, now every week the sessions, every week 2 sessions will happen for your Finance 360. Chalo. So this is it. Thank you everyone. Thank you for joining. I hope you enjoyed the session. See you in the next session. And do comment down below the homework questions. Do comment down below the answers of the question 1 and question 2. Whoever gives the right answer, I will comment below that they have given the right answer. So do give the right answer of the homework question. And if you are liking the session,